All right. Hello, everyone. Welcome to the second week of BSAD 525. I hope you all are doing well. We are going to be talking today about goals, values, and performance. So let me pull up our slides. There we go. And I'm just going to double check to make sure you guys can actually see this here. 1 second. Good. All right. So today we're talking about goals, values, and performance. In our last lessons, we were talking about how we measure performance using financial information and ratios, and then comparing those with other firms. As I mentioned in those lectures, company performance is always compared to something, whether that's your own firm over time and its past performance or other firms or industry averages. We're always comparing it to something else. Otherwise, we have no reference point. But with that in mind, let's start talking now about broader scope, values, performance, and objectives. We're going to be discussing strategy as a quest for value and what that means. We'll talk a bit more about how to analyze performance and what to do with that information. We'll talk a bit about other objectives in addition to profit, values, and corporate responsibility. And I'm actually not going to talk about real options too much. I'm going to really just gloss over that. It's worth knowing that it exists, but real options, that view of strategy depends upon a fairly sophisticated knowledge of options in finance. That's where this view comes from, and it adopts some of the same tools. I don't expect you guys all to know or understand how financial options are valued. Some of you may. Those are your call and your put options. That's what they're called. But we will really, as I say, summarize this quickly and gloss over it a bit. So what are businesses for? Um, every business will have its own set of goals and values or its unique purpose. And often that is imbued in the organization from its founding. The founding owner of a company and its founding CEO will tend to exercise a really outsized influence on the purpose of the firm that often exists even over hundreds of years and times when firms are very old. However, there are some commonalities between all firms, and there's a need to create value. And how do we measure value? Well, you may have heard of willingness to pay. We really don't have a better measure of value. Karl Marx, one of the great flaws of his work, he had a famous book called Capital. Karl Marx is the founder of really modern socialism and communist economics. And the big problem with his whole theory is that he believed value was just the sum of the labor that went into something. And obviously that's not true. Let's say Kobe Bryant or Michael Jordan or any of the great athletes of history, an hour of their labor playing basketball is worth a lot more than an hour of my labor playing basketball. And we know that because people will pay a lot more to see a great basketball player or a great athlete play, a lot more than they will to see me play or someone who does not have their talent. So there's something more going on here. And basically, we still have never come up with a better measure of value than what someone is willing to pay for something. That's how we know what something is worth. And that's really one of the great advantages of a monetary system and of free markets is that we can get that information and allocate resources effectively. So, a diamond is worth more to most people than a cubic zirconium or a piece of plastic. And we know that because people will pay more for it. There are reasons behind that that you will have learned in your economics class, supply and demand, but even demand itself reflects a willingness to pay, how much demand there is at each price. So generally speaking, all businesses share a common purpose at the general level to create value for customers and to appropriate that value or some of that value in the form of profit. Profit for a firm is like breathing and water. If you don't have it, you cannot continue to survive. You need to be paying the bills. If people won't, and I'll add one more stipulation to our discussion of value. You only create value, and a firm only creates value if the willingness to pay created by that product exceeds the cost of producing it. I might be able to get a small willingness to pay for some music I write and produce, but if someone isn't willing to pay more than it costs me to produce it, or at least the total demand for that, the total willingness to pay across multiple customers isn't worth more than what it costs me to produce it, I haven't created value. I might have really enjoyed it, but in a sense, value has been lost. It cost me more to make something than anybody was willing to pay for it. So that's why profit is also a necessity. There is some politicized discussion or polarizing discussion about, well, for whom does the firm create value? Who should it be creating value for? The traditional approach associated with an economist called Milton Friedman would say, well, the firm exists to maximize the wealth of the owners. Now, at its most basic level, if you think about a single owner firm, if you go out into business for yourself and you own a firm that you manage, of course, that's going to be true. It's your firm. And as the firm gets larger, it may have public ownership or widely dispersed ownership. Even still, though, the firm is owned by shareholders or the individuals who otherwise hold the ownership of that firm. And there's a very good rationale to say that the firm exists to maximize the wealth of the owners, with some caveats. Obviously, an entrepreneur might go into a particular line of business, not because it maximizes his or her wealth as much as they could invest elsewhere, but there's also a purpose to the company. Let's say Elon Musk and the Tesla, perhaps he could have made more money. Well, let's talk about something different. SpaceX. Arguably, Elon Musk could invest his wealth somewhere other than SpaceX and make a better return. However, SpaceX has a mission. So there's a need to maximize value, but as part of that mission. Otherwise, someone like Elon Musk or Jeff Bezos or another wealthy CEO founder of a company, well, why don't they just take their money and put it in the stock market, right? So there's shareholder wealth maximization, but there's also a mission and purpose. When we look on the other side here, now to the stakeholder approach, this is often pitted against the shareholder approach. The firm is a coalition of groups. It must create value for them all. And one of the things I like about this particular textbook by Grant is that he says, well, whichever view you take, the stakeholder approach or the shareholder approach, you still need to create value. And that's the thing. And in order to do that, we need to have a strategy and we need to survive the competition. So we have to earn a return on capital in excess of our cost of capital. This is that idea of economic profit or economic rents that I spoke about. We don't just need to make a profit. If we make a profit that's insufficient to cover the cost of capital that we have to pay to our financiers, we're still going to go out of business. So we have to earn at least a return above our cost of capital. Competition makes this more difficult. Also, if a firm isn't doing this, so another reason why both stakeholder approach firms and shareholder approach firms have to maximize profit is because, well, if a firm isn't doing this, and especially if it's publicly traded, it's going to get acquired and the managers are probably going to be fired and someone's going to be put in their place who will maximize the profit of the firm. Underperforming firms, if shareholders believe that someone else could manage the firm better and get better performance, they will replace the management team. They'll either do it, the shareholders will vote them out, or the firm will get acquired by someone who will then put in new board members to change the top management team so the firm starts pursuing profit and maximizing profit. And of course, between these two views, there's a convergence of interest. When we talk about shareholders, the primary shareholder groups of any firm are the owners, the shareholders, but also the employees of the firm and the customers of the firm and the suppliers of the firm, as well as governments and communities. If a firm isn't maximizing its profit, it can't create value for any of these groups, including shareholders, but also including employees, suppliers, etc. So a firm that's maximizing profit has more value to share, whether that be to the shareholders or other more diverse stakeholder groups. So we arrive at the same conclusion either way. The primary concern that we're going to have for strategy is to identify and access the sources of profit available to the firm and maximize those in conditions of competition. This is a handy little graph. I draw something similar to this in my in-person classes, but essentially we have here at the top, I'm going to see if I can get my little handy-dandy annotator out. There we go. This is our willingness to pay right here, this line. And whatever the customer paid, this is the price. The difference between what the customer was willing to pay and the price they actually paid is a consumer surplus. If I would have paid $20 for that first cup of coffee in the morning and I only had to pay $5, I captured $15 of consumer surplus. The difference between the price and the cost, now this is a bit tricky. They did this slightly different. So they say the real cost of production. So that includes everything done by the suppliers. And they say, well, that goes to all the different people in the supplier network. And then here is the cost to our specific firm. The cost of the firm to create this willingness to pay, and the difference between the firm's cost and the price the customer paid is the profit for the firm. Whatever the firm paid to its own providers, down here, well, they had their own cost structure, and here's their surplus, and really it just keeps going down and down from supplier to supplier. The price a supplier pays to the buyer creates the profit for that supplier and so forth. So you can think of value creation going all the way to the primary inputs, the natural resources, or what was taken out of the ground. So this is how we view value creation. And I'm just going to erase this here. What we're going to be most concerned with in this course is that willingness to pay. We have to create a willingness to pay in order to charge a customer anything. We're going to be interested in the price that the customer paid, and we're going to be interested in the cost to our firm. Now, obviously, our value as a firm that we call profit, well, the only two ways we can really make that bigger is in marginal terms, in terms of percentage of profit. Obviously, we can just sell more of the same product and capture more absolute profit. But in terms of profit as a ratio, our two options are to push down our costs, the price we paid for our inputs, and to push up the price. Now, obviously, we can't push the price up any higher than the customer's willingness to pay. And a lot of what we're going to discuss in this course is going to be related to, well, what determines the price that we can get for something within the customer's willingness to pay, and what determines the cost that we have to pay for our own inputs. So this is a really handy way to think of value creation and our firm. So how do we measure profit? We talked about this at length in our examination of how to measure performance financially. Here's some different measures given in the textbook. Market capitalization, you may be familiar with. That's just the total number of the firm's shares outstanding times the price of the stock. So if you have 1 million shares at $1 each, your market capitalization is $1 million. Sort of simple numbers there. We can also talk about net income. This is the accounting measure, revenues minus expenses. Return on sales, that's like our net income margin, right? Net income over revenue. Return on equity, that's our net income over shareholder equity, and return on assets, and return to shareholders as a percentage. I actually don't know what they're getting at here. I think this is just looking at changes in the return to shareholders, right? Because we have plus and minuses here. So this is just going up and down. As I mentioned in the financial analysis lectures, I like return on assets because that tells us how efficiently we're using our assets to generate profit. So as a measure, and we don't have to worry about the capital structure like we do with ROE. We just say, okay, well, the assets are either financed by debt or equity. Frankly, as managers, we don't really care because we could change that. We could sort of fiddle with the finances, borrow more money or pay off debt. So we're just interested in, well, how much net income do we get per dollar of assets? That's a pretty good measure. Market capitalization is also an interesting interesting figure. It's more prone to fluctuations in the market. If the whole market goes up, our market cap probably goes up too. If the whole market goes down, probably goes down too. I mentioned this in our last lectures. So it's not our best measure of performance. But what's important about stock measures related to the stock price, is it does reflect and contain the expectations that investors have for our firm. If a firm makes a strategic decision that investors think is unwise, that's going to be reflected in the price of the stock. The stock price will go down if the investors think the company just made a bad decision. Likewise, if investors think the company just made a great strategic move, then the stock price will go up. Enterprise value is a way to think long-term about a company's cash flows. You guys may be familiar with enterprise value. It's basically just a discounted cash flow analysis from your finance class. And this is probably the best way to think about profitability for your firm. If we're just thinking about quarterly profit, well, it's very easy to maximize profits in the short term by selling off assets or engaging in activities that aren't long-run sustainable. We stop investing in R&D and just lower our expenses. That gives us a temporary boost in profits. But enterprise value reflects the long-term, in theory, the indefinite cash flows of our company over our cost of capital, right? Our WACC is our weighted average cost of capital. I don't even care if you understand this formula for our purposes here. You should have understood it to pass finance. But basically, we're just saying that maximizing total enterprise value is really the best way to think of our job. We don't just want to maximize a short term. We don't just want to maximize cash flow in some future period. We want to maximize the total cash flows over time to our firm going off into the indefinite future. And that gives us the longest possible view of our cash flows, and that'll be reflected in the whole value of the company. That's what we're trying to maximize in strategy, not just short-term profitability, not just the next quarter, not just the next year, but the potential profitability and future cash flows into the indefinite future. So it says here that this is the right view. In principle, a discounted cash flow approach to maximize enterprise value is the correct approach for choosing strategy. We look at different alternatives. We estimate the cash flow from those alternatives and the cost of capital for each strategy, right? Different investments have different costs of capital. If we take on a really risky investment, it might have high cash flows, but our cost of capital might also increase, which makes the discounted value not linear, or rather the enterprise value doesn't go up linearly with the increased cash flows because we're discounting it based on the riskiness of the venture. And then in theory, we would select the strategy which generates the highest enterprise value or net present value. That all sounds good. But if that was all we were talking about, you wouldn't need this class. You would have discussed this already in finance. And of course, in practice, all forecasts are wrong. No discounted cash flow analysis ends up being completely accurate. There's variance. So it can be hard to do this effectively, to strategically maximize enterprise value. And sometimes this can encourage short-termism. Now, interestingly, one of the best little witty sayings I ever heard was from the fellow who wrote the book, literally, on stakeholder management, a scholar called R. Edward Freeman. And he said, well, the best way to have a good long term is to have a good short term and just keep it going, which I really like. But how do we keep that short term going, a good short term going? Well, simple guidelines can help us maximize the rate of return. We want to maximize the rate of return on existing assets. And if we're going to invest in new projects, we want to make sure the rate of return on those new investments are positive NPV analyses. But the fact of the matter is, this isn't strategy is often more of an art than a science, and we're going to have to use a lot of qualitative analysis. And if you were to ask a guy like Warren Buffett or read his work, he was not really doing discounted cash flow analyses. That wasn't how, or if he was, they were couched in a lot of qualitative analysis. He was looking at what we call the fundamentals of the businesses, making predictions about the future, and really choosing, sort of using a best case or rules of thumb to try and estimate which companies were undervalued, which those were the ones he wanted to buy, and which ones were overvalued, in which case he'd avoid them. But the fact of the matter is, it's not just a straightforward DCF, and we don't do, generally speaking, discounted cash flows in this course for reasons that we'll talk about. Here's some other profitability ratios and some notes on these, including the formulas. I'm going to move on from this slide. We've covered most of these already. This is a little note on why we prefer enterprise value even to maximization of shareholder return. Partly it mentions here, it's not always easy to distinguish debt from equity. There are different ways of financing firm assets. Also, this view to maximizing shareholder return, shareholder or stock markets are very volatile. There's a lot of behavioral economics involved. Every shareholder wants a good next quarter, and oftentimes even the shareholders themselves they don't have a long-term view. So again, enterprise value is better here, maximizing the total future capital. In theory, this enterprise value should equal the market capitalization of the firm, but of course, that's not really true. The capital structure affects it, but also the behavior of investors and other things in the market. So enterprise value here is again better than just maximizing quarterly shareholder profits, whatever's happening at the next earnings call. Doesn't mean we don't pay attention to earnings calls. Doesn't mean we don't keep a close eye on quarterly profits, but we take a longer view in strategy. By definition, strategy is about long-term objectives. Here's a way that our financial analysis can be disaggregated. We're analyzing profit, in this case, through return on assets. Well, that has two components. There's our sales margin or gross margin, right? That's COGS over sales. There's other things, ways we can break that down. We can look at depreciation. We can look at SG&A. Actually, this is probably the net income margin. And then we can see how efficiently we're generating revenue, not profit in this case, with our assets. And there's all sorts of different numbers and ratios we can look at here that we discussed in the last lecture. This is kind of a handy little way to see how these all connect. I'll mention again here, This is, I believe, net income margin, which is net income over sales. Let's put net income over sales or revenues. And these are the different drivers of that and different ratios that go into that, all of which we looked at in the last lectures. This is sales over assets, or total asset turnover, we called it in the last lectures. And these are the drivers of that. Now we're putting income statement items over balance sheet items. Right, here's our balance sheet items. Here's our income statement items. So different ways to break down ROA, our measure of performance, into smaller units of analysis. Here they've given an example of a specific firm, UPS versus FedEx, and they've compared how these things break down. And if you were doing a financial analysis, this might be where you'd look and you'd say, okay, well, UPS has a much higher return on asset. Where is this coming from? If we look at sales over assets, the difference, or total asset turnover, the difference is still there. It's about a 30%. UPS is about 30% better there, so that's significant. They certainly do much better in terms of their operating margin. And then we could look and say, okay, well, labor costs, actually, UPS spends much more on labor costs. Where is it saving money? Well, transport that's brought in is lower. Fuel costs are about the same. Maintenance is lower at UPS. Depreciation is lower, which means they're spending on assets, if we were to look at that, is probably lower. Other costs as a percentage of sale are also lower. So interestingly, even though they spend more on labor, in most of the other areas, they spend less and have lower costs than FedEx. In terms of working the assets, UPS, we see here, gets more revenue per dollar of PPE, property, plant, and equipment, which is probably why this looks better. Oops, sorry, not this one. Why this looks better, they have lower depreciation, which indicates they're creating the same or more revenues with a lower asset base. Receivables turnover is slightly lower for UPS, and their turnover of cash is about the same. So if I was going to make a call here on what's really driving UPS's superior performance, well, a lot of that is coming from their better use of assets, generating revenues as much or more than FedEx with a smaller asset base, based just on what we can see here. And again, better on transport, better on maintenance, which again makes sense if they have a smaller asset base. So an interesting way to start breaking down this overall performance measure in an actual comparison with two firms. And as you can see, they've compared two firms here, which is what we always do when measuring performance. Who's our main competitor? If you were to ask yourself who's UPS's main competitor, I'm sure most of you would instantly say FedEx. So it's probably a very good comparison. Now we take a different view. This is using return on capital invested. But now they're looking at activities and they're comparing, or at least mapping out the activities in a more strategic way. We have these activities that are really happening at the CEO level. We have corporate divisions and decisions that are being made there. We have the functions, marketing, finance, accounting, departments and teams. And really, as we get closer to the line staff, the people actually making the product or delivering the service, that's where we get to these activities and how efficiently and productively they're carried out. These are done more by and managed probably more by middle management, etc. So these activities roughly correspond to levels of the firm hierarchy, roughly speaking, I say. So another useful view on how to analyze firm performance, first from a financial point of view on that last slide, and then analyzing these even deeper and looking at what are the activities that are actually driving these costs. If you remember or if you've taken a cost accounting or a management accounting course, That's where specific numbers are actually attributed to different activities. Here's another way to look at the same thing broken down even further. And now we even have targets at each level of activities for each level of management. Or sorry, not each level of management, but different activities. So this is how strategy might look on the ground. This is how they're measuring performance. These are some hypothetical targets that might be set. These are some initiatives, strategic initiatives that are part of a larger strategy to feed into these drivers of value creation and cost reduction. This is a regional airline. So these are the sorts of activities they would segment their operations into, and the targets they'd set at each of these levels for these different parts of the operation, all feeding into a strategy that we don't know yet. Are they trying to be a differentiated airline that provides a luxurious service? Are they trying to be a low-cost airline like Southwest? How these numbers play out would really depend on what their strategy is, and that would determine the targets they would set in each of these areas. Here's a cautionary tale about pursuing short-term shareholder profit maximization. Boeing, one of the two great airplane manufacturers, the other one being Airbus, which is out of Europe, their initial goal was just to build great planes. That was the purpose of the company. And the firm actually had relatively little emphasis on financial management, and its performance was strong throughout all these different series of projects. These are all different plane models that they came up with and built, all very successful, both in terms of the end product and also in terms of the financial performance. More recently, starting in 1996, these two individuals took control of the firm, and they said, no, we're just going to focus on creating shareholder value. And one of the examples I mentioned, they cut R&D because that's an expense, diversified into electronics and other segments, lost its leadership of commercial airplane manufacturer to Airbus. And you've probably all heard of the 737 MAX, which is really a reflection of all these cost cuts. If you want a lesson in how poor management can destroy a firm and destroy a valuable brand, you could hardly choose a better example than Boeing. They have been plagued by problems, which all at root, if you look into the case, stem from poor leadership and a poor focus. They lost their purpose. They weren't trying to build great planes anymore. They were just trying to get as much money out of the company as possible. And they lost that focus on value creation, which means they lost their market share to a competitor that was creating customer value and willingness to pay that they weren't. So we don't, as I say, just pursue profit in and of itself. In most cases, there are a few exceptions. If you're just an investment firm, well, then you are just trying to pursue pure cash profit. But most firms and operating firms are trying to generate profit by producing great products and services for which they have a strategy. Looking even further beyond profit, some firms choose to have values that go beyond profit generation, and some of them even engage in what's called corporate social responsibility, or CSR, for shorthand. Maybe they have certain ethics or certain company values. Maybe they have values related to how they're going to treat their customers and their staff. And these can be very useful. The values that are instilled at the CEO level tend to get reflected and cascade downwards. If you have a CEO like Boeing's newer CEOs that really are just care about getting as much cash out of the company as possible, well, maybe employees start cutting corners and quality assurance fails if that's not being emphasized enough in the values. If a firm has good set of values, that can be very motivating to employees. It can help them with decision making and all those aspects of strategic reinforcement we discussed in the first lecture. It helps people make decisions if they're dealing within a common value framework, and it can enhance unity. Values give something for people to and employees and even customers to rally around. There are firms that have very strong values that are recognized as part of the brand, and that really makes people proud to work at those companies and customers proud to buy from them. Think about Harley Davidson, not as much now, but in the past, they were seen as a very patriotic American company that made quality products that were tied to the American way of life, if you want. And that people, I knew someone who worked at Harley Davidson. She absolutely loved it, said it was a fun company to work for, an exciting company. It had sort of a free-spirited ethos that was exciting. So values can give that to a firm. When it comes to corporate social responsibility, there are different approaches. We're not going to talk a ton about corporate social responsibility in this class, except in so much as it becomes strategic, I guess, you might say, and in so far as it becomes something that creates value and increases the enterprise value of the firm. But it's worth knowing that these views exist. So the evolutionary view says that firms are part of an ecosystem and have to help protect those ecosystems. That is, of course, true. If you are a lumber company that cuts down all the trees in your environment, you are going to kill your own ecosystem and you won't be able to survive. Michael Porter's view, someone who will come up a great deal in this course, one of the real godfathers of the strategy discipline, said that firms should create value in a way which also creates value for society. Nothing there that anyone would argue against, of course, but things get a bit more tricky when you start to talk about or maybe segment, okay, well, are there particular segments of society that I want to create value for? Maybe I'm really into art and culture, and I think my firm that I'm the CEO of should donate $100 million to the Metropolitan Museum in New York. And if I happen to get invited to the Met Gala, well, isn't that nice? That's what we call an agency problem. And that's one of the thornier parts of firm corporate responsibility, is that you start to have agency problems. What an agency problem is, it arises from the fact that you have a manager who doesn't own the company, who is stewarding the assets of the shareholders. Now, if I own and manage my company, no problem. I do whatever I want with the company's money. It's my company. I'm the manager. If as the manager, I decide I want to take somebody out golfing every day, well, I'm the owner too, so I'm not spending someone else's money. But as soon as we have a separation between ownership and management, corporate social responsibility can start to raise some thorny problems. The CEO will be motivated to give the firm's resources, the shareholders' resources that he doesn't own, to causes that he or she favors, that the shareholders may not favor. And you do see this coming up a fair bit with some of the activist investors lately, guys like Robbie Starbuck and other shareholders who are saying, look, we actually don't like you spending our money on some of these causes. They don't align with our own values or our own politics. And so you can end up having infighting between shareholders and even managers over who are we going to give our money to, which may and is already starting to lead some firms to go back to their knitting and say, you know what, we're just going to make our product and service. We don't really want to get bogged down with political discussions or take stances on geopolitical issues that are polarizing, because our shareholders aren't united, maybe even our management and staff aren't united. Let's just stick to our core line of business. So a brief view of CSR, corporate social responsibility. I don't think it comes up in the cases. It may come up with your firms or not. By all means, analyze it and think about these things. Think about whether you think it is increasing shareholder value. Are the company's CSR activities polarizing? Are they potentially losing customers or losing investors? Are they drawing in more customers and more investors? Some firms, if you have a very particular set of values and segments, that might be fine. A company like Patagonia, part of their selling, what creates the willingness to pay on part of their customers is the fact that they have values related to environmental protection and stewardship. And so anyone investing in that company is probably going to be aligned with those values. And the customers are certainly see that as something that increases their willingness to pay and increases their allegiance to that brand with Patagonia. Other firms, maybe not such a good fit between certain CSR activities and the values of the firm and the customers and other stakeholders of that firm. Here's that real options view that I was talking about. I'm going to be really quick here. Basically, the idea is the option to invest in a project for a firm in the same way that we can use a discounted cash flow analysis to price the value of that project. We can also treat it as an option and use option pricing models to value not the project itself, but the option to either invest in that project or not invest in that project. Having lots of different projects that we don't necessarily have to pull the trigger on creates financial benefits. Even if we don't invest in the project, having the option to invest in that project at a later date creates something that can be valued like a financial option, a call or a put option. If those don't make sense to you, or if you're not familiar with those, don't worry about it. You might be familiar with the Black-Scholes formula for valuing an option or the binomial pricing model from finance class. We are not going to talk about these in this course. Some of you may be disappointed. If you are, don't worry. It just means you just apply these formulas to the value of a project and what your strike price is for that project. There you go, real options. If you don't want to use it, great. Don't worry about it. You don't have to. So, summary of this lecture, strategy is a quest to create value. To maximize this willing to pay and reduce our costs, right? Here's the total value created as a firm. And then this value is shared between the firm and the customer based on wherever the price is. The higher the price, the more value is captured by the firm. The lower the price with respect to the willingness to pay. I'm just going to put buyer here because it's shorter. The more value is captured by the buyer. But if we're creating value, that's a good thing. It's value that didn't exist there before. Customer gets some value, hopefully. Firm gets some value. The customer has to get at least break-even value, otherwise they won't buy it. Likewise, the firm. So value creation is good. It's a great way to measure performance. And we need to maximize value creation as part of our strategies if we want to be a successful firm. There are ways to analyze that performance. We can break down our chosen measure of performance, like return on assets or other measures of performance. We can break those down into smaller ratios that analyze individual line items, like I talked about in our common size financial statements. Look at each line of the income statement, figure out how are we doing on costs in each area compared to our chosen firm that we're comparing ourselves with. We may choose to go beyond profit, and most firms do. They have a set of values, they have a purpose, and value is created as part of that purpose, right? SpaceX creates value in addition to just shareholder value. It's exploring space. If we one day are able to colonize Mars, they will have created profit as part of a broader mission. Henry Ford created profit, but he could have just lent money or speculated on railway stocks, but instead Henry Ford created profit while building the modern vehicle, which has created value for all of us today. And strategy generates value not just by cash flows, but also by creating the options for future cash flows. We will not really worry about this in this course. Good. So that is the end of this lecture. Looking forward to seeing you all in the next one. This one kind of basic in some ways, but it's important to have that discussion about what kind of goals do we set and what can we say is a general performance goal for the firm. Every firm has its different purpose, but all firms need to seek to maximize value and the enterprise value of their future cash flows. Charity, car company, investment company, every firm you guys are looking at needs to be doing that for the health of the firm to survive the competition and in order not to lose your job if you're the manager. Great. We'll see you all in the next lecture. Bye-bye.